Hi, good day and welcome to Investing Basics, the asset classes unpacked. Today we're going to be talking about cash or the money market. Now, cash really is by a long way the simplest of all the asset classes. Cash really represents principally deposits with the banks, and there you might go even into longer dated fixed deposits such as 2 or 3 years. But the technical definition of the money market or cash is really any investment or debt instrument rather that has got a lifespan of a year or less to maturity. So obviously the biggest players in this market would generally be banks and government. When you look at the examples of money market instruments or money market assets, stuff that's very familiar to most people: normal current accounts, savings accounts, money market deposit accounts, call accounts, fixed deposits, notice deposits, and then when you get into sort of the bigger money and slightly more complex, you get to negotiable certificates of deposit, so-called NCDs, as well as some slightly more creative investments options such as step-up deposits. So that's what the banks generally offer, and as we say, most of the bank funding actually comes from the money market, with a relatively minor portion coming from their capital base and the longer term debt market. Then government also is quite a significant player in the money market. Obviously, short dated instruments like treasury bills represent quite a big part of it. But then also we would throw any bond that might have had a long term maturity, say 20 years, but only has 1 year left to run. And then increasingly we're finding that the corporate sector, big corporates, are tapping into to the money market as an alternative to, say, getting bank funding. All right, so what does the investor get? As we said, the money market or cash is really very simple. You invest in a short-term financial instrument. You have a relatively high or very high probability of getting your capital back, but for that security you get a fairly nominal interest rate. Interest rates are either fixed or variable. And when you look at fixed interest rates, those are, for example, on fixed deposits, on NCDs, for example. When you look to the government debt market, of course, treasury bills, which are very short-dated paper, but also offering the investor a guaranteed yield. And then you get variable interest rates. Those are interest rates essentially that move with some other reference point. So it might be the central bank, say in South Africa, the repo rate, or the Fed fund rate, or the base rate. And then others obviously just move along with supply and demand of money. That would be, for example, LIBOR or JIBAR links. So really what you get, just to summarize, a very secure income stream, a high visibility of your capital base, and unfortunately for that one gets relatively anemic returns. All right, just looking at an example of the returns in the money market. Generally we would see money market yields around the gross inflation rate. So if inflation was running, for example, at 5%, we would expect short-dated money market instruments to be yielding around that. And then equally, if inflation is running at 2%, you would expect those sort of numbers. We understand that from the global financial crisis in 2008 up to 2015, that was not the case. Generally, returns on money market assets were well below the inflation rate, and that was really as a consequence of the monetary policy stance of many of the central banks around the world. But coming back to it, we would say generally you'd earn roughly the gross yield, a gross yield roughly equal to the inflation rate. So 5% inflation rate would probably see money market rates around the 5% mark. In South Africa and many other countries, that interest is taxable. So if we took a scenario where inflation's at 5%, call rates are at 5%, let's say tax is at 40%, your gross return is 5%, but obviously you're going to pay tax of 40%. That brings your actual return down to 3%. And that really means that after inflation you've got a negative return of minus 2%. So that's the 5% inflation less what you're actually getting of 3%. Now that negative compounding is not a big deal on the short to even medium term, maybe a couple of years, but on a long period of time, say 10 or 15 years, that negative return has a massive impact when you compound it. And of course, the other important thing to remember is that if you invest 100 today, you'll get 100 back, say, a year from now, together with interest. If you use the interest, of course, your 100 no longer buys 100's worth of goods. In a 5% scenario, its buying power has eroded to 95. This next graphic just illustrates the scenario I was just talking about: 5% inflation, 5% money market rate, and a 40% tax rate. And as you can see, over a period of 10 years, the inflation index on a 5% inflation rate goes from 100 to just over 160, and your after-tax cash position has grown to a little over 130. So effectively, that compounding effect really shows the destructive nature of cash on the on the long term. All right, so in conclusion, we've obviously been fairly critical of cash, but there are a couple of positives to cash. Firstly, and most importantly, everybody should have a certain base amount of cash, whatever that number might be, 3, 6, 9 months worth of living expenses, and that's just to protect you against life's uncertainties. Cash is also potentially a very, very useful tool in liberating the other asset classes. So, for example, somebody who needs a certain level of income may actually keep a pot of cash back and use that, let's say 5 years worth of income requirements, keep 5 years worth of required income in that cash account. You progressively drip feed yourself that, but then the nice thing about that is that you can then focus on the other asset classes, equities, property, and possibly bonds, and trying to liberate those to achieve growth. So cash can be quite a useful tool, as I say, in liberating the other asset classes. And then probably the most important thing is an old saying in the market, and that is that cash is king. And that really relates to the fact that it protects you against asset price decline. So if the equity market is overvalued, obviously by being in cash, you protect your 100, it remains at 100. But also the other logic with that is that if you hold cash when asset prices are overvalued, it can give you a wonderful opportunity to come in and snap up bargains. So it is a net asset value or portfolio protector. So those are the positives. The negatives, as we've illustrated, the returns are poor, and we believe very negative after inflation on the longer term. One thing we must also say is, maybe 20 years ago, the man in the street didn't really have the opportunity to benefit from wholesale deposit rates. With the advent of money market funds, money market unit trusts, or collective investment schemes, that's freely available, and many cash management solutions offer the man on the street very similar interest rates to what big institutions with a billion times the assets would be able to achieve. But important there to shop around, look at different products. Don't just look at simple deposits, look also maybe at money market funds, and always shop around, both on service provider and on maturity. All right, so generally we would see cash as fairly value destructive on the long term, and as such we would typically hold a fairly small cash weighting over an extended period of time. This video was really just intended for educational or instructional purposes. It shouldn't be conceived or perceived, as financial advice, and we'd urge you to seek the advice of a professional before making any decisions.